Hi there, it's Friday the 12th of June 2020. I'm Steve Towers. Welcome to ITB. Let's get started. As you know, the last ITB video was on the 29th of May, which is 2 weeks ago. There are a number of important stories which emerged during the first week. I've included those stories in today's video, but to distinguish them from this week's stories, they're marked as catch-up stories. The US Trade Representative has commenced a Section 301 investigation of digital services taxes which have been adopted or are under consideration in 10 jurisdictions: Austria, Brazil, the Czech Republic, the EU, India, Indonesia, Italy, Spain, Turkey, and the UK. Of course, some of these jurisdictions don't use the term Digital Services Tax or DST. For example, India's Equalisation Levy and Indonesia's Electronic Transactions Tax. The Section 301 investigation will determine whether each DST is unreasonable or discriminatory and whether it burdens or restricts US commerce. You'll remember that the USTR issued its Section 301 report on France's DST in December last year. For a copy of the USTR's announcement of the investigation, please go to our website or app. Meanwhile, in the Czech Republic, the government has announced that it will reduce the rate of its proposed DST from 7% to 5%. And that it will defer its effective date to 2021. The Platform for Collaboration on Tax has released a toolkit in regard to developing countries taxing offshore indirect transfers of assets. For a copy of the toolkit, please go to our website or app. The OECD has released a new version of its database, which contains tax policy and administrative measures implemented by specific countries in response to COVID-19. For the link to the database, please go to our website or app. In Australia, the government has announced an extension to the 31st of December 2020 for its instant asset write-off measure for income tax purposes. This allows a company with annual turnover of less than 500 million Australian dollars, which is about 350 million US dollars, to expense for income tax purposes acquisitions of assets which individually cost less than 150,000 Australian dollars, which is about 105,000 US dollars. In China, the tax authorities have announced that the existing income tax incentive for the integrated circuit design and software industry has been extended to eligible companies which became profitable by the 31st of December 2019. For a copy of the announcement, please go to our website or app. In India, the Authority for Advanced Rulings has rejected an application for capital gains exemption under the India-Mauritius Treaty in regard to an indirect share transfer. The AAR's ruling is based on the so-called look-at principle, the common law anti-avoidance rule which was described by the Supreme Court in the Vodafone indirect share transfer case. You will recall that the AAR also applied the look-at principle to deny the capital gains exemption under the India-Mauritius Treaty in a case earlier this year. The taxpayers are 3 Mauritius companies which are subsidiaries of a US company. The Mauritius companies own shares in a Singapore company. The Singapore company in turn owns shares in several Indian companies. Those shares represented the major asset category of the Singapore company. The issue in the case was whether the residual paragraph in the capital gains article, Article 13.4, in the India-Mauritius Treaty exempted the Mauritius companies from the Indian capital gains tax on indirect share transfers, which would apply under Section 911. As I said, the AAR rejected the capital gains exemption on the basis of the common law look-at principle. In other words, when the facts are looked at objectively, the conclusion is that the Mauritius companies were interposed between the US parent company and the Singapore company solely for tax avoidance purposes. For a copy of this case, please go to our website or app. In Japan, the tax authorities have issued guidance on the corporate tax consolidation regime as amended in the 2020 tax reform. For a copy of the guidance, please go to our website or app. In Malaysia, the government has presented a National Economic Recovery Plan, which includes significant tax incentives for companies relocating operations to the country. The incentives include income tax exemptions for 10 or 15 years for qualifying manufacturing operations, and investment tax allowances. For a copy of the government's booklet on the plan, please go to our website or app. And also on tax incentives, the Malaysian tax authorities have issued guidance on tax incentives for BioNexus status companies. For a copy of the guidance, please go to our website or app. In Taiwan, the government has issued guidance on the tax treatment of leases which are covered by IFRS 16. For a copy of this guidance, please go to our website or app. In Thailand, the government has approved a bill to impose VAT on inbound digital services. It will now be considered by Parliament. For a copy of the bill, please go to our website or app. In Belgium, the government has introduced into Parliament a bill which would provide further assistance to the COVID-19 economic crisis. In particular, a 1-year tax loss carryback from 2020 to 2019. This will apply to estimated tax losses in 2020, subject to conditions, and a tax-exempt reserve fund, which would operate during the 2021, 2022 and 2023 income years. For a copy of the bill, please go to our website or app. In Cyprus, Parliament has approved changes to the country's notional interest deduction rules in regard to 3 items: the reference interest rate, the definition of new equity, and the 80% cap on deductions. In Denmark, the National Tax Court has decided a case which shows the importance of having good transfer pricing documentation. The taxpayer manufactures ice cream production machines and sells them to related party distributors in other countries. The taxpayer incurred significant EBIT losses for many years. Under the Danish tax law, the tax authorities generally have the burden of proof in regard to the application of the arm's length principle. However, the court considered that the taxpayer's transfer pricing documentation was inadequate, and that led to 2 consequences. Firstly, the inadequate documentation means that the tax authorities were permitted to make a discretionary estimate of arm's length prices. And the second consequence is that in making that discretionary estimate, the tax authorities were permitted to apply the transactional net margin method with the taxpayer as the tested party, even though as a manufacturer it was more complex than the related party distributors. And this second consequence followed because the taxpayer's transfer pricing documentation gave inadequate information in regard to those related party distributors. For a copy of this case, please go to our website or app. The European Court of Justice has decided 4 VAT cases. I've described the first 2 here. Please hit the pause button to study this. And here are the descriptions for the other 2 cases. Please hit the pause button to study this. For copies of the 4 cases, please go to our website or app. In the EU, you'll remember that there was a cryptic reference to additional company tax, 10 billion euros, in the European Commission's EU budget plan, which I covered in the last ITB. Well, a few more details have emerged. It looks like the proposal is for an EU tax of 0.1% or possibly a slightly higher rate on the turnover of large companies which benefit from the EU's single market. A Commission spokesperson said this: depending on the design, whether a lump sum or a fee proportional to firm size or a portion of a tax on profits, around 10 billion euros could be raised without excessively weighing on any individual firm. 10 billion euros is less than 0.2% of the turnover generated by the EU operations of those large companies. Also in the EU, a political agreement has been reached by member states to defer the reporting deadlines under the DAX 6 directive. You'll remember that the European Commission proposed such a deferral in May. Under the political agreement, member states will have the option to use these deferred reporting dates. Please hit the pause button to study this list. In Germany, the government has announced a major economic stimulus package. From a tax viewpoint, 3 items caught my eye. Firstly, VAT rates will be reduced from the 1st of July 2020 for 6 months. The standard rate will fall from 19% to 16%, and the reduced rate will fall from 7% to 5%. Secondly, the maximum amount for the 1-year tax loss carryback will be increased from 1 million euros to 5 million euros. This increase will apply for tax losses incurred in 2020 and 2021. Also, a so-called Corona Reserve will be able to be created to effectively allow a 2020 loss to be immediately recognised in the 2019 tax return. And thirdly, accelerated tax depreciation for movable business assets will be introduced for 2020 and 2021. In Italy, the tax authorities have issued guidance in regard to dividends paid to an authorised contractual scheme established by a pool of UK pension funds. The guidance considers the rate of Italian dividend withholding tax, which should apply both before and after the expiry of the Brexit transition agreement, which is currently scheduled for the 31st of December 2020. For a copy of the guidance, please go to our website or app. Also in Italy, the tax authorities have issued guidance on the reporting obligations for online marketplaces. For a copy of the guidance, please go to our website or app. In the Netherlands, the government has announced that effective 2024, the country will have a conditional withholding tax on dividend payments to shareholders resident in low-tax jurisdictions or jurisdictions included on the EU's list of non-cooperative jurisdictions, currently 21 in number. The government has said that draft legislation will be published before the end of its term, which is March 2021. For a copy of the government announcement, please go to our website or app. In Norway, the Supreme Court has decided a transfer pricing case in regard to a cost contribution arrangement within the Shell Group. The taxpayer, a Norwegian company in the Shell Group, conducts R&D. It recovers 40% of the R&D costs by charging unrelated parties for access to the results of the R&D. However, it makes those R&D results freely available to other Shell Group companies. The court accepted that the taxpayer's relationship with those other Shell Group companies was a CCA. The issue in the case was whether the cost base for allocation under the CCA should use 100% of the R&D costs incurred by the taxpayer or only 60% of those costs. In other words, after deduction of the amounts charged to the unrelated parties. Not surprisingly, the court held that 60% was the correct arm's-length answer. The court said this: the decisive factor is that in the relationship between the taxpayer and the shell companies abroad, there is a cost contribution arrangement, which means that the actual cost for the taxpayer will be distributed based on the company's relative benefits. In this context, the share of the cost of R&D projects charged to the unrelated parties cannot be considered as a cost to the taxpayer. For a copy of this case, please go to our website or app. In Poland, the government has announced that the start date for the mandatory use of the new electronic VAT reporting system will be deferred from the 1st of July 2020 to the 1st of October 2020. In Slovenia, the tax authorities have issued guidance on the financial services tax. For a copy of the guidance, please go to our website or app. In Spain, the government has announced the introduction of a tax on the manufacture or import of non-reusable plastic packaging. In Kenya, the tax authorities have released for public comment draft regulations in regard to the imposition of VAT for supplies which are made through a digital marketplace. You'll remember that this measure was included in the 2019 Finance Act. Public comments are requested by next Monday. For a copy of the draft regulations, please go to our website or app. In Mauritius, the government has presented its 2020 budget. There are several interesting items. Firstly, Mauritius will join many other countries in imposing VAT on inbound digital services. Secondly, the government has announced that a levy will be imposed on the gross income of companies which have, or which are members of groups which have, annual gross income exceeding 500 million Mauritian rupees, which is about 12.5 million US dollars. The rate will be 0.3% for insurance companies, financial institutions, service providers, and property holding companies, and 0.1% for other companies. However, exemptions will apply for companies operating in the tourism sector or, importantly, which hold a global business license. Thirdly, an 8-year income tax holiday has been granted to certain manufacturing companies. And finally, the budget contains several other corporate income tax incentives, such as double deductions for certain R&D expenditure and the extension of investment tax credits. For a copy of the government's explanatory notes on the budget, please go to our website or app. In Namibia, the government has presented its 2020 budget. Only one item caught my eye. the government has reversed its decision, which was announced in last year's budget, to disallow deductions for mineral royalties paid by non-diamond mining entities. In Nigeria, the government has issued an order which defines what constitutes a significant economic presence, or SEP. You'll remember that in the 2019 Finance Act, an SEP rule for corporate income tax purposes was introduced to deem a Nigerian source for non-resident companies in two situations. Firstly, non-resident companies operating in the digital services and e-commerce sectors. And secondly, non-resident companies which furnish technical, management, consultancy or professional services outside Nigeria. According to the order, in regard to the digital services and e-commerce sectors, an SEP will exist in any of three scenarios. In the first scenario, the non-resident company derives gross turnover exceeding 25 million Nigerian naira, which is about $65,000 from a range of digital services. In the second scenario, the non-resident company uses a Nigerian domain name or registers a website address in Nigeria. And in the third scenario, the non-resident company has a purposeful and sustained interaction with persons in Nigeria by customizing its digital page or platform to target persons in Nigeria. Interestingly, the order says that despite the introduction of the SEP rule, the order will be trumped by a multilateral agreement or consensus arrangement to address the tax challenges arising from the digitalisation of the economy, to which Nigeria is a party, which is obviously referring to the Inclusive Frameworks Digitalisation Project. However, there is no reference to the interaction between the SEP rule and Nigeria's existing bilateral double tax treaties. Presumably, the treaties will prevail. For a copy of the order, please go to our website or app. In South Africa, the tax authorities have issued updated guidance on the income tax treatment of headquarter companies. For a copy of the guidance, please go to our website or app. In Bahrain, the tax authorities have issued guidance on the VAT treatment of the retail and wholesale sectors. For a copy of the guidance, please go to our website or app. Two countries in the Middle East have taken opposite paths in regard to customs duty. In Israel, the government has announced that it will reduce customs duty rates and purchase taxes on a range of consumer goods, whereas in Saudi Arabia, the government has increased the customs duty rates for a wide range of foods, industrial products and vehicles, effective Wednesday this week. In Saudi Arabia, the tax authorities have published the second edition of their transfer pricing guidelines. For a copy of this document, please go to our website or app. And also in Saudi Arabia, the tax authorities have published the English language version of their guidance on the transitional rules for the increase in the standard VAT rate from 5% to 15%, effective the 1st of July. You'll remember that the Arabic version was published several weeks ago. For a copy of this English language version, please go to our website or app. In Brazil, the Superior Court of Justice has decided a case in regard to the application of the Brazil-France Treaty to technical service fee income paid to a French company with no PE in Brazil. The facts are quite straightforward. it was accepted that the French company did not have a PE in Brazil. The French company is a member of a group which has as its main business activity the provision of technical services in regard to the manufacture and maintenance of submarine cables. The Brazil-France Treaty has a business profits article, Article 7, and a royalties article, Article 12, which are relevantly the same as in the OECD Model Treaty. Interestingly, however, it does not contain an other income article. Thus, there's no presumption that all types of income are dealt with by the treaty. For many years, the Brazilian tax authorities have resisted the argument that outbound technical service fees are exempt under the business profits articles of treaties. Instead, they have said that such fees are covered by the royalties article or by the other income article if it allows source country taxation, or the fees fall outside the scope of the treaty. Well, the court held that the fees don't fall within the definition of royalties in Article 12, and they don't fall outside the scope of the treaty. Instead, Article 7 applies to provide an exemption from Brazilian tax. From an OECD viewpoint, that, of course, is the right answer. But having regard to the history of this issue in Brazil, this is a significant decision. For a copy of this case, please go to our website or app. Canada has become the latest country to issue guidance on the double tax treaty impact of the COVID-19 travel restrictions. For a copy of the guidance, please go to our website or app. In Colombia, the government has issued a decree containing thin capitalization regulations. For a copy of the decree, please go to our website or app. In the US, another development in the Altera transfer pricing case concerning employee stock option costs. You'll remember that the government recently filed its brief which opposes Altera's appeal to the Supreme Court. Well, Altera has now filed its reply brief. For a copy of this reply brief, please go to our website or app. And now for this week's treaty developments. We've had one treaty signed, one protocol enter into force, and one treaty terminated. I have 3 articles for you this week. The first article is called Most Favoured Nation Clauses in India's Tax Treaties. It's written by Mukesh Bhatani and Taran Jain, and it's published in Tax Notes Today International. This article explores a number of interesting issues with MFN clauses in India's treaties. For example, despite multiple decisions since Steria holding in favour of the automatic application of the MFN clause, the legal position is far from settled in light of the Indian Tax Administration's persistent disagreement. Notably, the position of the Indian Tax Administration is not without substance. For example, consider those DTAs that provide that a subsequent beneficial DTA with an OECD country will provide the same benefit to the earlier DTA. Several claims appear to have been made relying upon this type of MFN clause and citing the India-Slovenia and India-Lithuania DTAs on the premise that they are OECD countries. Those claims are made despite the fact that India entered into a tax treaty with Slovenia in 2005 and Lithuania in 2012, whereas they only completed their accession to OECD membership in 2012 and 2018, respectively. The Indian Tax Administration may be correct in its contention that the automatic triggering of MFN clauses fails to address the possibility of a later occurrence that wasn't contemplated by the treaty partners at the time of treaty negotiation. Ultimately, taxpayers and the tax administration alike will have to wait for a categorical verdict from the Supreme Court to reach finality on the issue. The second article is called Australia Changes to Hybrid Mismatch Rules. It's written by Anton Joseph and it's published in the IBFD's Finance and Capital Markets Journal. This article provides a good description of the proposed changes to Australia's hybrid mismatch rules, which are in a bill currently before the Australian Parliament. The changes relate to consolidated groups, trusts and partnerships. And the third article is called Taxation of Cross-Border Services, a Latin American Perspective. It's written by Nicholas Arias and it's published in Tax Notes Today International. In this article, the author discusses the various types of taxation in Latin America in regard to cross-border services. For example, VAT, income withholding taxes, gross receipts taxes, export duties and remittance taxes. Well, that's the way it is this Friday, the 12th of June, 2020. I'm Steve Towers. Have a great weekend.